Jenny, you would have seen the chart that Rebecca just referenced before. I want to throw up the one that's showing the diverging price between short-dated Huarong bonds maturing in July and the longer-dated credit perpetual, particularly, I should say, when it comes to the perpetuals. You can see that wariness still play out when it comes to the longer-dated paper, right? So where's the investor mindset at this? Because what we heard from Zeng over the weekend almost seems to suggest that this is a too-big-to-fail situation.
Good morning. Yeah, the confidence, the investor confidence, particularly in the offshore market, is shattered for sure, and it takes time to restore. I mean, investors not only need words, but also need actions. But we see that Huarong has been acting to the right direction, trying to restore this investor confidence. Huarong may not be a household name, but there should be no doubt that it is a systemically important financial institution with a very strategic mandate to deal with China's bad debt problem, which is crucial to China's financial system. And it is also a major issuer in both the onshore and offshore debt market with RMB 17 trillion of assets. So it is essential, actually, to restore that confidence among the investors.
Does that confidence get restored unless we hear something from authorities, from the government? Because is that part of the problem, creating more uncertainty that there's no confirmation that a restructuring will go ahead, for example?
Well, so far, what we have been hearing are more and more news towards that what we believe that a corporate and a business recalibration may be needed to position Huarong better for the future. But this doesn't equal, and it's far from a debt restructuring. So any debt restructuring of Huarong most likely will trigger a disorderly chain reaction in China's both domestic financial market and the offshore market. And the particularly domestic market, this is something the government is extremely anxious to avoid.
We have already seen the repercussions with the China-U.S. Treasury's yield spread narrowing. This GTV chart on the Bloomberg showing you that. But despite the spreads narrowing, we know that China's 10-year yield, for example, is almost double that of Treasury. So how attractive do the Chinese markets still are they still right now?
The Chinese CGB remains extremely attractive. This is any other major bond market in the world that's actually manifested by very strong inflows into the Chinese bond market since April last year. I think last year we have RMB 1 trillion of inflows in 2020, and I think this year that inflow continued. And there are two reasons for the remarkable inflows. One is the widening interest rate differential between CGBs and the U.S. Treasury, and the two, of course, is the strengthening of Chinese currency. And do we think that's going to continue? And we do think so. The very, very short-term momentum of RMB may slow down due to some cyclical reasons, right? So for one, the PBOC may calm the enthusiasm on RMB to make sure it doesn't really appreciate too much and too fast, and may hurt the exports when the world economy is recovering. And two, there could be risks on growth perspective should China's policymakers are overzealous in their attempts to deleverage the economy, causing the increase of tail risk. But nonetheless, we remain very positive on RMB's mid to longer outlook, and we believe the inflow will continue.
How will the inflationary picture play into the markets?
The key question here is whether the short-term spike in prices flows into longer-term inflation expectations. For the last month's print and the CPI numbers in the U.S. are mainly driven by some transitory factors, so the used cars, air tickets, and so on. So the inflation expectations have moved higher for sure, and the nominal U.S. rates have been stable. So that means that the real interest rate has fallen about 30 basis points, and this means policy has become even more accommodative as the economy is recovering. Is this necessary? Probably not, right? So we do think that the Fed will start to talk about tapering earlier than expected, and that actually could potentially cause some market volatility in the near term.
Jenny, I want to end on our question of the day on our MLive blog. How do we best navigate data distortions? And the question of the day is specifically talking about the wild swings that we get when we look at the base effect, right, with a number of data points. But I'm also wondering, when you take a look at inflationary data that then takes into account swinging energy prices, it takes into account just the extreme nature of fiscal and monetary policy stimulus that we've seen. How do you get a base level that makes sense for your forecasting?
That's obviously challenging, and all the data now is distorted by very short-term opening up of the economy, and so those are all transitory factors. And also, when we know major assets price are mainly supported by the QE, unprecedented QE program, physical spending, and when that started to reverse, we should not be very surprised by the higher volatility that it's going to cause to the market.